Ladies and gentlemen, good day and welcome to DATAMATICS Global Services Limited Q2 FY21 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta from Christensen IR. Thank you, and over to you, ma'am.
Thanks, Aman. It gives me great pleasure to invite all of you for the Q2 FY21 earnings call for DATAMATICS Global Services Limited. The results and investor presentation have already been mailed to you, and it is also available on our website www.datamatics.com. In case anyone does not have the copy of press release and presentation, please do write to us and we will be happy to send it out to you. To take us through the results today and to answer your questions, we have with us the top management of the company, represented by Rahul Kanodia, Vice Chairman and CEO, Sandeep Mantri, the CFO, and Mitul Mehta, the Senior VP and Head Marketing and Communication. We will be starting the call with brief overview of the quarter given by Rahul, which will be then followed by financials given by Sandeep. We will then take the Q&A session. As usual, I would like to remind you that anything that is said in this call, which gives any outlook for the future or which can be construed as forward-looking statement, must be viewed in conjunction with risk and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus with SEBI and subsequent annual report, which you can find it on our website. With that said, I now hand over the call to Rahul. Over to you, sir.
Thanks, Asha, and welcome and thank you everyone for joining our Q2 FY21 earnings call. We're glad to have you all on the call today, and I would like to start by wishing you all a very happy Diwali in advance. We announced our Q2 results on November 4th, detailing out our operational performance, and I will touch upon some of the key business performances, and Sandeep will update you on the financials, and post that we can get into a Q&A. Despite the shadow of the pandemic, I am happy to see that we are recovering from the Q1 slowdown and bouncing back to a growth path once again. At DATAMATICS, we are working relentlessly as a team to service our customers and have more meaningful engagement with them during these challenging times. Q2 was a good quarter for us. We reported a revenue growth of 3.1% quarter on quarter. However, the highlight of the quarter was our margin resilience. Our EBITDA grew by 15.3% on a quarter-on-quarter basis, which improved about 122 basis points to 11.5%, which is on the back of cost-cutting and cost optimization, as well as revenue growth. On the business front, our IT services, which constitutes 55% of our revenues, witnessed a decline of 13.3% on a year-on-year basis and 1.2% on a quarter-on-quarter basis. The decline was mainly due to closures of some projects and the loss of a key customer. The loss has been partially recovered by new customers and some of the existing customers. Our BPM services, which constitutes 45% of our revenue, witnessed a growth of 10.5% on a year-on-year basis and 8.6% on a quarter-on-quarter basis. The growth was primarily driven by a rebound in banking and insurance, back office processing, and new projects in customer management services. We have signed some new deals that would enable us to see continued and healthy performance in H2 of this year. We expect about a 3% growth over H1 and a 11 to 11.5% EBITDA as compared to 10.3% last year. We now are a debt-free company and have a healthy cash balance of 181 crores as we speak. Digital automation is an important focus for DATAMATICS, and in this area too, we have won some marquee logos. We are getting very good traction from the market on the launch of our TrueBot 4.0, and we will continue in investing and building our robotics product. DATAMATICS recently expanded its strategic alliance with Ingram Micro in the META region, which will provide DATAMATICS access to Ingram Micro's vast network of resellers across this META region. While the pandemic continues to create uncertainty due to the second wave, DATAMATICS will continue to focus on opportunities in digital automation, investment in our products, and manage costs within our control. Our attention to execution, strong customer relationship, and solid foundation gives us the strength and stability required for this market. We are seeing demand revival, and customers are accelerating the spend on advanced technologies. I believe the current situation is vibrant for growth for outsourcing businesses, as there is a rise in demand for cost reduction and creating more opportunities for companies like us. Once again, I wish you all a very happy Diwali, and I will now hand over the call to our CFO, Sandeep Mantri. Sandeep, over to you.
Yeah, thank you, Rahul. Good afternoon to everyone on the call today, and I thank you for joining us on our Q2 FY21 earnings call. Let me start with the key financials for the second quarter ended on September 30. So our net revenue for the quarter was at 285.6 crore, a growth of about 3.1% sequentially, and a 3.7% drop from last year's same quarter. In this, we have to adjust 1% impact due to divestment of one of our subsidiaries last year, as we would have degrown only 2.7% instead of 3.7% on a YOY basis. And also some impact of COVID on revenue is evident, right? The ratio of IT and BPM remains at 55-45. Our IT services revenue for the quarter were at 154.3 crores, a drop of 1.2% sequentially and 13.3% from last year's same quarter. Our BPM revenue remains at 131.3 crores, a growth of about 8.6% sequentially and 10.5% over last year. Let me come to EBITDA margin. EBITDA margin for the quarter was 11.5% as compared to 11.3% in the same quarter of last year and 10.3% in last quarter. So in both the quarter, compared to both the quarters, we have improved in terms of our EBITDA margin. In spite of slower revenue growth, we were able to sustain this healthy EBITDA due to cost optimization and automation primarily. Our other income for the quarter remains at 1.1 crore compared to 2.4 crore in the previous quarter. This other income is low because of reversal of exchange gain, as the realized rate and the actual rates are almost same. There is no, significant. There is no great gap compared to last year. Our profit before tax for the quarter was 23.1 crore as compared to 29.5 crore in the same quarter of last year and 19.6 crore in last quarter. So we have improved compared to last quarter. However, we are yet to go back to our last year same quarter performance. Our effective tax rate for the quarter was 26.5% as compared to 28.2% in the same quarter of last year and similar figure in last quarter also. So as communicated earlier also, our estimated tax rate should be in the range of 25 to 26%, 27%. Tax rate normally differ due to geographical mix of profits. We have operations in different geography, and this results into this variation in tax rate. Our diluted earning for the quarter was 2.62 per share, higher than Q1 where we were at 2.29 per share. Now coming to half yearly financials, our revenue was at 562.7 crore, a drop of 4.1% on YOY basis. In this also we have to adjust 1% impact due to this divestment of one of our subsidiaries last year. Otherwise we would have degrown only 3.1% instead of 4.1% on YOY basis. And some impact of COVID on revenue is also evident. Our BPM revenue were at 252.3 crores, a growth of 5.3% on YOY basis. IT revenue were at 310.5 crores, a drop of 10.6% on YOY basis. EBITDA margin in H1 of this year is 10.9% as compared to 11.8% in H1 of last year. Our EBITDA margin in BPM is 0.9% as compared to 11.3% in last year. So we have almost 260 basis point increase due to this cost optimization and revenue growth in BPM. EBITDA margin in IT remains under pressure at 8.5% compared to 12.1% last year. Major reason I would attribute to a loss of a key customer and closure of some of the projects, and also budget constraint at few customers and resulted into price pressures and ultimately resulted into lower margins in IT segment. Our other income remains at 3.5 crore compared to 7.9 crore last year. Again, this is primarily due to exchange gain, which is not there in this year because the realized and actual rates are more or less same. So as a result of all of above, our profit before tax for first half is 42.7 crores as compared to 56.8 crore in last year same period. Our EPS is at 4.91 per share compared to 6.65 per share in last year same period. Coming to balance sheet, as I communicated in last earnings call, we have repaid all our debt. We were having 96.5 crore in borrowing when we started the year. Today we are at zero, no debt borrowing in the group. There is no debt in the group as of today. As of September 30, our net cash and liquid investment stood at 181.5 crore compared to 124 crore. So this is a significant 58 crore addition to our free cash in last 6 months. Our DSO is at 77 days for the first half as compared to 83 days in last year. Our current ratio is also healthy at 3.38 compared to 2.37 in March 20. So there is a vast improvement in all balance sheet parameters. Our cash flow from operation continues to be healthy as against EBITDA of 61.5 crore for the first half of the year. We have generated operational cash of about 66.3 crores during the period. Free cash flow grew significantly in H1, driven by mostly consistent focus on liquidity and a cash management at our end. As mentioned by Vice Chairman and CEO Rahul Kanodia, liquidity, cash flow, and cost control continues to remain on our top priority. We managed to control cost by releasing some real estate, more offshoring of BPM work, increased automation in process, and reduced travel and some other initiatives. So in terms of our geographical footprint, the US comprises 54% of our business, India is 20%, UK is 12%, Europe is 5%, and rest of the world is about 9%. In terms of industry footprint, the largest segment for us is the BFSI segment, which is 27% of our revenue. Tech and consulting is 24%, education and publishing is 20%, manufacturing is 5%, retail and e-retail is 6%, and others are 18%. So our client concentration remains healthy with top 5 clients contributing about 27%, top 10 at 38%, and top 20 contributing 50%. And this is more or less similar to last year. So I will now pass on the call to operator to open the floor for questions. Thank you very much for your patience, and I appreciate your continued interest in DATAMATICS and wishing you a happy Diwali in advance. Thank you. Operator,
Thank you, sir.
The floor is open.
Yeah. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question at this time, they may please press star and 1. The first question is from the line of Keshav Garg from CCIPL. Please go ahead.
Sir, our Q2 results are encouraging, and it seems that the worst is behind the company, and company has cash balance of over 50% of market capitalization, and still company has chosen to be a zero dividend paying company. So I think that is the primary reason why our stock is probably the cheapest IT stock on the stock market. So until and it is also encouraging that company has started doing conference calls, but unless the company pays some dividend or does some share buyback, and until the market thinks that this company, whatever money it is earning, at least something is coming to the shareholders, so it is very hard to see how our share will get re-rated. So what are your thoughts on this issue?
So Datamatics has been declaring dividends every year. So we've been very consistent in our dividend declaration. It was only this year, because of COVID, that we pulled back on dividend. Right now, as we mentioned, that our focus is going to be on conserving cash, because this year is a little bit of a turbulent year. So whether we declare dividend or not for this financial year is a call that we will have to take as the management and as the board when we come to the year end. But as of now, we are not planning to declare any interim dividend. Otherwise, we would have done it by now because this year. But traditionally, we've always been declaring dividend every year.
So that is true, but it was a token dividend. So basically, the payout ratio is very less, even when we used to pay dividend. So until it is like 20-25% of the profits of the year, then if you see IT industry, all players, the big guys, they pay over 50% payout. But since we are in a growth stage, but at least 20-25% payout ratio, if a IT company can answer debt-free company with cash surplus, so then the market thinks that then what is there for shareholders over here?
Sure. I hear your sentiment, but I think we will certainly discuss this in the board. And what we will do this year remains to be seen on how the second half of this year unfolds. And then certainly we'll take this sentiment on board.
Okay, so thank you very much. And sir, also wanted to understand that what percentage of our total revenues are coming from digital, and what percentage is the conventional IT, which is at the risk of getting automated?
So it's very difficult because we don't track digital. Today, the term digital is permeating all our services. So if you look at the things, what comprises digital is mobility, analytics, artificial intelligence, robotics, and things like that. So there are flavors of this coming into every service line. So it's very difficult to purely distinguish traditional IT from digital, because even traditional ITs is now getting flavors of either mobility or AI and things like that. So we've got digital now cutting across, but this is something that we will see. Traditionally, we were tracking it, but then as it sort of permeates in every project, it becomes very difficult to distill out digital versus traditional.
So basically what I'm trying...
Sorry.
So basically what I'm trying to understand is that what percentage of our revenues approximately are at the risk of getting automated, and which might become redundant, or we might lose that kind of business in the coming few years? Sure.
No, good point. So that impacts the BPM side the most. However, in our case, because we have our own technology, we are able to deploy it into our BPM processes, and you can see that impact on the EBITDA. And also we are able to disrupt competition. So in that sense, our BPM business is not heavily threatened because we have our own technology which is threatening competition. And on the IT side also is similar.
So that is very encouraging. And sir, lastly, wanted to understand why our operating margins are on the lower side if we compare them. Even small IT companies which are even smaller than our size, they are also doing over 15% of EBITDA margins. So why is it that we are barely making double-digit EBITDA margins? And also, what are you doing to increase EBITDA margins going forward?
Yeah, so we've already started taking action on that. We've automated a lot more of our processes. We've cut the fat wherever we could. There is still some more ground to cover on that. So that should help improve. Having said that, we've been investing very heavily in some technologies, and those investments are expensed out. They are not capitalized. And therefore, the margins are a little subdued because we are not capitalizing. We are expensing all the investments we are making in building products and tools.
Sure. Sir, so and now that in Q2 results, you think that this trend of recovery will carry on, and do you see by third quarter or fourth quarter, when do you see year-on-year growth coming in?
Yes, so I did mention that in my address. We do expect this trend continuing, and we will observe for another quarter, but looks like H1 and H2 should be better than H1. And last year we ended the year at 10.3% EBITDA. This year we should close between 11 and 11.5% EBITDA, and the revenue will also be on an upward trajectory. Q1 we were hit very hard, more so because of loss of a customer and a few profitable projects. But as you see in Q2, we've grown 3.1%, and I expect this kind of a trajectory to continue for this year.
So best of luck, and sir, please consider a share buyback. I think that it will lead to serious re-rating of our stock. Thank you very much.
Thank you.
Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, thank you very much, sir. So in the past, we have spoken about like the product that we have been developing in last 3-4 years.
Yes.
So we expect a good growth because of that going forward. So when do you see that start hitting the P&L and we start seeing a decent trajectory in terms of growth?
Yeah, I expect that to kick in the next financial year. So this year we've launched it. Unfortunately, this year because of COVID, it kind of got impacted a little bit in terms of our reach out in the market. But we've been rated by Everest, and in fact we've moved up the ladder as far as their rating is concerned. We've also got the largest repository of use cases in that segment of robotics. So I'm hopeful that next financial year, starting April, we should start seeing some impact of that.
And what's the opportunity size we are talking about here?
The opportunity size is a multi-billion-dollar because the robotics and automation industry is very, very hot, and Gartner is rated as the fastest growing segment today. So you're talking about, Mithul, do you have the number handy in terms of the robotics industry?
Yeah, Rahul, hi. So typically the robotics industry is growing at about CAGR of 50 to 60% until about last year. This year we have to see the numbers not yet released. And currently I think the software industry stands at about $2.6 billion.
Okay. So when it starts kicking in FY22, now we are talking about maybe 3% quarter on quarter or a sequential growth, right? Maybe in the balance part of this year. So once this start kicking in, how do you see that trajectory, 3% going up to 4-5% on a sequential basis?
It should. We are focusing on getting these partners. We've recently signed up with Ingram Micro in the META region. We signed them up in the India region. We are in dialogue with them on the APAC region as well as Europe and the US. So once these relationships get stabilized and firmed up, then I expect a significant growth. So yeah, to your point, yeah, it could be in that range, but of course we need to look at that once these relationships get signed up.
And this you're expecting by first half of next year, like FY22?
It should start. Some results should start coming in.
Okay, fair enough. And now you made one more point about all this cost that you have been doing, you are expensing, right?
Yes.
So now is the time, maybe next year, when you will start getting the benefit of that.
That's correct.
So how do you see your EBITDA margin? Because EBITDA margin is depressed because all this cost that you have been doing for all the last 3-4 years.
So what will happen is that the revenue growth hopefully should pick up. On EBITDA, we will take a call because we will have to now invest heavily on sales and marketing. And particularly marketing is when you do product business, if you see the sales and marketing budgets of product companies compared to services companies, they're about 3 times more than the services companies. So we will have to increase our spend on sales and marketing. And our initial agenda will be to get revenues going and capture market share. So I would be a little hesitant to make a comment on the EBITDA, but it will remain healthy, that's for sure. But once we finish the budgeting in the next quarter, we'll have an idea of how the budgets are for the next year. So apart from saying that it will remain healthy, and I'm confident of that, I cannot give a number because we still have to do the budgeting exercise for sales and marketing for the automation area.
Understood. Fair. Okay. Yeah, that's it from my side. All the way best.
Thank you. The next question is from the line of Dipesh Sancheti from Manya Finance. Please go ahead.
Hi. Wish you a very happy Diwali in advance.
Thank you.
Just wanted to know about your TrueBot services. How much of the revenues come from one time and how much is from the AMC of TrueBot?
Yeah, so right now most of them are the annuity license revenues. So once you sell a license, there's a renewal every year. It's a subscription model. One-time services are very small because one-time services relate to implementation, and we are not doing too much. We are encouraging partners to do implementation, although we have done some of it. So the bulk of the revenue is an annuity type.
So it's repetitive?
Yes.
Okay, and how much is it? Can you quantify it?
We don't give that kind of segment-wise breakup or service line.
It is right now. It is very small segment, so we are not disclosing the number of this segment.
Okay.
We will disclose it appropriately sometime next year or next to next year when it becomes a really reportable number right now.
Okay, so you expect it to grow in the next few years?
Yes.
Okay, that's great. Because apparently this is something which AI is the next thing, and this is something which has excited us to invest in your company also.
Yes.
Okay, and you said something about a loss of a customer. How much of sales have we lost because of the customer?
So the IT revenue, if you notice, came down by about 13%.
Yes.
Sandeep, what was the so this one customer would have been in the range
of about $3 million approximately. Yeah.
Oh, fairly large.
Yeah.
Fairly large.
Okay, and how are we planning to recoup those revenues?
So some of this is already recouped, and I think if you see our quarter-on-quarter top is only 1% approximately, and some of this will be recouped in next few quarters. We have some good pipeline. We should, if materialized, then I think we will be again back on the same path.
Yeah. Sorry, the 3 million is H1, right? So you were analyze it.
I'm saying H1 only.
So the 3 million was H1. So approximately
6 million.
6 million. And how old was this customer?
Maybe 5-6 years old.
5-6 year old.
Yeah.
Okay. And is there any particular reason for the loss of customer?
No, actually, no reason in terms of our ability to deliver. What happened was this customer split into two companies, and their business therefore changed. So when they split, one company continues to work with us. The other company chose to go with another vendor, and that other company was a larger chunk of it. Oh. The one that continues to work with us is actually a much smaller piece.
Okay. That's right. Fine. That's it from my side. If there's any other question, I will join you again. Thank you.
Yeah.
Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, please press star and 1. The next question is from the line of Ankit Gupta as an individual investor. Please go ahead. Ankit, your line is unmuted for questions. You may please go ahead. Ankit Gupta, your line is unmuted for questions. You may please proceed. It seems there is no response from the line of Ankit. We will move to the next question. That is from the line of Vaibhav Barjatia from HNI Investments. Please go ahead.
Yeah. Hi, sir. Thanks for providing the opportunity. Just wanted to understand more on the products business. So you have some product in your IT solutions vertical. You have some products in your BPM vertical as well. Obviously, as as we've understood, the product business are really, really different from normal IT business. Can you provide more details around what kind of products are these, in which specific applications they are used, and what is the current revenue from products business per se, so that we can understand at which stage they are in, and what kind of investments are required to scale up these products?
Sure. So I can give you some insights into the product. I'm not so sure I'll be able to give you the revenues from each line, each product. So one is in the area of robotics, which is focused on process automation. It's called TrueBot. Then another one is in the area of data capture. It fits into the robotics, so it augments the robotic business. This is called TrueCap Plus. The third product is in the area of analytics, which is called TrueBI. Then we have another product in the case of fare collection. It's called TrueFare. This is where we use these platform for the metro projects that we do.
Yeah.
And then we have another one in trade finance and e-office. Trade finance is where these bankers use that for Axis Bank and those types of banks. And the last one is e-office or e-govern, where everybody is now going digital, even including the public sector bodies. So those are the large products that we have. Most of them, there's another one which is not really a full-blown product, but it's a platform called IPM, which is a payments processing platform. So these are all almost ready, all of them. Of course, the product business, you have to constantly enhance a product. So there's constant investment going in constantly improving it and adding new features and functionality. But most of these products are ready. So the bulk of the spend now will happen on the sales and marketing front.
And as of now, I don't want product-wise breakup, but overall, from the product business as such, will it be possible for you to share the revenue?
We'll have to compute that and come back to you.
It is very insignificant right now, because these products are like RPA and everything is, commercially we have started from last year only.
But as Sandeep mentioned, I think from next year, as some of them get more significant, we would be in a position to share those data.
Some material, then we'll start sharing things with our
Right. And in order to understand the potential of these products, can you help us understand, which specific applications these products are used, like for example RPA and this TrueBI product? Is it like they are really catering to the wide market, or there are specific niche applications where these products are being used?
So TrueBot, TrueCap are in a very wide segment. TrueBI is also applicable in a very broad spectrum of industries and operations. TrueFare is something very specific because it goes into the fare collection space only. Trade finance is also very specific. It only goes into the banking. And e-office is also a little specific because it largely goes into a certain segment within the public sector. So 3 of these products are broad spectrum products, and 3 of them are very specific.
Right. And so any comments on a specific competition for these products, for example, like TrueBot or TrueBI? Any already are there any established products?
Yeah. There's quite a few of them. So in the BI space, there's ClickView, Tableau, Power BI from Microsoft, and then you've got the traditional SPSS, SAS, those types of products. In the area of TrueBot, you've got Automation Anywhere, UiPath, Blue Prism. These are the more prominent ones, and then there are several others that are there. In the area of TrueCap, you have Abby and you have TOCR, but we are slightly different in the sense that we would use these as engines and then add further value through artificial intelligence and things like that. So we don't compete directly with them. We in fact leverage their engine and then add more value.
Got it. So, lastly, given the size of our balance sheet and given the kind of business we have,
Yes.
And there are so many competitors, and as you rightly said, there is a constant need to invest in R&D side of these products and also sales and marketing.
Yeah.
Do you think that we have the relevant financial bandwidth to just go aggressively and monetize these products, or organically, or we need to, we will probably develop them at particular stage and then sell it off, or what's the overall plan?
Yeah. So to really get into the big league, you're right that we will need to leverage it and get some investment into the company, whether it is into this products subsidiary or into the parent is a debate we'll have. But we are a little premature to bring in investments yet. For some time, we are able to sustain it from an organic perspective. And once it gets to a certain critical mass, we will explore the options of getting investment into the company.
Right. And as of now, all these products put together would be loss-making given the investment that we are doing? Do our overall...
Yeah, you could say that, yes. All of them put together, we will be loss-making.
Yeah, we will be loss-making.
But the strategy behind that was that 2-3 years ago, when we looked at our business, the services business is increasingly becoming a commodity, and we wanted to segregate ourselves from the pure services market, and therefore we decided to go down the products because that gives you potential for inorganic, not inorganic, but at least non-linear growth.
Right.
And it allows us to differentiate our offerings.
Got it. I think that's it from my side. A request, if you can from next quarter onwards, if you can just highlight what is the loss that is there in the product vertical, so that we can easily see what your IT services business exclusively is doing and what is the product. We understand that product business is really relatively long term in nature and initial investments are really high. But if we know the quantum of it, we will be really conditioned to appreciate your services.
Certainly, we will maybe next quarter, perhaps certainly from next year, perhaps. But we will we take that point and we will highlight that.
Okay, that's it from my side. Thank you.
Thank you.
Thank you. A reminder to our participants: if you wish to ask a question, please press star and 1. The next question is from the line of Ankit Gupta as an individual investor. Please go ahead.
Yeah, thank you for taking my question. So it was more of a generalized kind of question wherein with whatever is happening in the company, just wanted to get a fair idea regarding what is the kind of growth that we foresee for the next 2 to 3 years down the line, and what would be the key drivers that would drive that particular growth. Also, if you could give some light on the deal pipeline that is there for the second half and coming down over there, so that would also be very helpful.
So on the deal pipeline, I'm not so sure I would have specifics as to how many deals got signed and what is the value of the deals, but generally it looks healthy, and therefore we had the confidence that H2 of this year will look good and compared to H1. So we feel good sign-ups, and we are confident that will continue. In terms of the 2 to 3 years going forward, the profile will shift more towards products and then services. So I expect that should improve our bottom line and also give us a healthy growth. So in terms of numbers, I don't want to hazard a guess in terms of numbers, because this year we're still going through the impact of COVID, and we're still trying to figure out how we need to manage the current situation, because Q1 was hit quite hard. But certainly when we come to the year end, we will be able to have a plan for the next year and give you better insights into the projections for next year. So although I hear you, and I'm sorry I may not answer your question very specifically, but certainly towards the end of the year we will be able to give a better picture as to what's going to happen the year after.
Sure. Thanks a lot for answering my question. Thank you.
Thank you. Ladies and gentlemen, that would be the last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you.
Sure, thanks. Thank you everyone for being with us on this call, and we are very confident and upbeat about the prospects that we have for the company. I think towards the Q4 of this year, we will get a good handle on what the plans are for the next 2-3 years, and we will be happy to present those plans to all of you. So thank you for being on the call and wishing you a happy Diwali again in advance. Thanks again.
Thank you.
Thank you very much. Thank you. Ladies and gentlemen, on behalf of DATAMATICS Global Services Limited, that concludes today's call. Thank you all for joining us, and you may now disconnect your lines.